if we're all telling our clients that we're going to close on time, have great customer service, be great communicators, have very low interest rates and competitive costs and fees, we're all just racing to the bottom there.
Yep.
Right? But if we can start to offer something more substantive, if we can start to give a value proposition that's longer term, if we can start to manage liabilities and debt at a higher level and help people towards generational wealth, we can step into a space that doesn't exist.
Please welcome Ryan back to the AI stage. He joined us last year, and we get to continue the conversation with a few more topics this year.
Looking forward to it.
Let's do it. Yeah, so last year you're up here with Sarah Wheeler, editor-in-chief, and Chad. Good conversation on why you had brought Neo to Better. So we're not going to recap all that. If anyone's interested in some of that context, the video is available on HousingWire and on YouTube. But we're going to dig in to how Ryan's journey at Better is going, some of the changes that have happened in the last week, and also talk about how AI is impacting his business and what he's seeing in cost of origination and a few other important topics. But Ryan, I know you, as the founder of Neo, you brought your business to Better, and you bought into the Better story. So give us some background on Better, the story of Better, and some of Vishal's zone of genius that attracted you.
Yeah, when we were initially, when they reached out, the question that we asked ourselves was, what happens if we stay comfortable? Right? What happens if we stay on the same path? And if you look at what Better had built, it had evolved, and you could kind of see it evolve in real time when they understood what a really good mortgage advisor who's financially literate, who understands that buying a home is more about emotion than logic, right? Helping people through the emotional management of money. When they realized that was possible, because their whole frame prior to that was kind of like your call center loan officer, right? Which is just a very different dynamic. And they started building the technology for that, right? To empower that individual, that mortgage advisor. And so there's obviously a lot of history with Better and where they started, what their initial intention was. But that evolution, especially over the last 2.5-ish years, has really allowed us to do some incredible things, and I think we're still on the very cutting edge of what's possible.
Yeah, the story's definitely changed. The first time I had Vishal on stage was in, I believe it was 2018. We hosted our Engage marketing event in Charlotte, and I remember being on these tall, awkward stools with Casey Crawford from Movement and Vishal next to him, and I think the whole conversation was about implementing title into the mortgage process. But the story definitely changed over the years as technology changed.
Yeah, well, think about it. I mean, his initial interaction was with LendingTree as his entry point into mortgage, and he just got bombarded by a bunch of call center loan officers that were just pitching rates and trying to get them approved. Nobody could get them approved, ended up not getting the home. And so, like, if that's your frame of what the mortgage industry is, you're going to try and displace that because you see a real opportunity for technology to take that segment of the marketplace. But then when you see what a real financially literate, highly educated mortgage advisor could do in a local community, then you say, that's what we really need to build around, right? We need to stop thinking of the mortgage industry as, a human-centered manufacturing process and start thinking it as a technology-centered process where humans can be the most human.
But when you made this commitment and partnership, you were bringing together a retail business. Like, give us a glimpse into the scale that your Neo team originates and the makeup of your originators, and how you thought those individuals, those originators, could come into this environment with a different manufacturing process.
So the whole theme around Neo is to create a new experience for the consumer, right? It's to help the consumer proactively for 30 years and give them advice and guidance and strategy and spend more time with them than just, here's your pre-approval, go find a home. And that was great, but it started to become pretty tedious when you're spending so much time with the client and then you have to go do so much work otherwise. And so we were always looking for, how do we remove 99% of the work off of the originator's plate to allow them to spend more time with the client, more time in business development, more time actually having educational and advice-based conversations. And there was really nothing out there that allowed that, right? I mean, all of the legacy systems created drag and friction and challenges. And so as soon as we saw this, it was like, well, this is obviously the play, even though it wasn't built for us, right? So it was built for the consumer, And then over the last 2.5 years, we've built it for the distributed retail originator. And there's two tenants, right? There's the DTC tenant, and then there's the retail tenant. And again, we're still early on it, and there's still a lot of room to go.
And so much of your decision-making rhymes with some of the learnings that Joe Willey talked about this morning in his session about using AI, using technology to help producers, whether we're talking real estate or mortgage, get closer to providing actionable advice versus making cold calls all day long.
Yeah, I mean, it's what we need to do as an industry, right? The mortgage industry can't keep selling loans. And if everybody in this room is an originator, which I know you're not, but let's say everyone is, if we're all telling our clients that we're going to close on time, have great customer service, be great communicators, have very low interest rates and competitive costs and fees, we're all just racing to the bottom there.
Yep.
Right? But if we can start to offer something more substantive, if we can start to give a value proposition that's longer term, if we can start to manage liabilities and debt at a higher level and help people towards generational wealth, we can step into a space that doesn't exist. And that's why we need technology to take everything else, because that is a massive endeavor, and it scares people because they think, well, whether you're helping 3 families a month or 30 families a month, both of those originators are overwhelmed. Right? So they don't know how to get into that longer term value proposition and how to execute on that commitment without everything else being removed.
Yep, absolutely. And the founder of Better, Vishal, I mean, his vision is probably one of the most disruptive visions I've heard from a founder and operator in the housing industry. We've had several conversations about his views on staffing models in the industry, what AI would assist, but also what AI should control from start to finish. And I'm kind of leading into last week, a massive announcement about a week. Was it last Monday or Tuesday? I guess we're
last Monday. Feels like a year ago.
Last Monday, a year ago. You did not have a 40-hour week in the last week?
No.
Yeah, didn't think so. So pretty massive announcement. Vishal Garg stepped down as CEO of Better. Tell us what's transpired in the last week and how the organization is responding.
Yeah, organizationally, everybody understands like the discipline required to execute right now. If you look at the amount of time, energy, money, and investment that have gone into building the platform to this place, and what he's been able to create in terms of platform partnerships and opportunities for mortgage professionals like us to talk to more consumers, it's been brilliant. It's been amazing, right? But every mortgage or every company in general kind of reaches a point where the vision takes you so far, and without that operator and without the discipline execution and without the people to say, okay, we see where you're going, but we need to build this and focus on this now, then the future stuff becomes noise, right? It becomes stuff that we don't actually need or we can't execute on. And so we're just kind of reaching that phase where he's realizing, and I think the company realizes, we need to focus right now on execution of the platform before we take that next exponential leap forward. And so it's just I think a natural evolution for somebody like that. I know that when I was originating, I was very much a future-oriented thinker, and it wasn't until I brought my operator in that we actually really took off. Before that, we were just spinning wheels, and I was able to go do what I did, but I couldn't get any real traction, right? And I think there's some parallels there.
But it's interesting, in the last 5 years, we've seen many more companies in our industry, mortgage and real estate brokerages, go public through the SPAC deals of 2020 and 2021, and a few public offerings. So this management change, this leadership change is playing out in the public eye as Better as a public company. When you've gone through changes and bringing on your partner, and like you had the benefit of doing that kind of like inside of your own walls.
Yeah, not a lot of reporters calling me when that happened.
No. So when every reporter in the country is covering this, I mean, it was on CNBC, Wall Street Journal, HousingWire covered it in many different ways. Like, how do the employees, team members, like stay focused and continue their belief in the innovation path? Because part of the issue that was raised here in the leadership transition was like some of the spending on technology and profitability. So does the path continue? Does the investment continue when you go through this type of change?
Yeah, I think it has to. I mean, just today we saw, one of the largest AI companies or AI chip makers in NVIDIA announced that they're going to work with BlackRock and Goldman and all these, Blackstone, to raise $500 billion from that pool of capital. So it's not debt and equity anymore, right? It's actual institutional investments. And I think the number is $7 trillion invested in AI by the end of the decade, and we're 3 years in, right? So in a 7-year span, we're going to look at $1 trillion a year in investment going into AI. And I think that in our little world of mortgage, it's not unfathomable to believe that some of the numbers that we're looking at today in terms of investment capital are probably underinvested, if you look at the grand scope of what AI can and should do.
I think you can make the argument that the only public equities that have performed worse than mortgage stocks in the last 60 days are the AI stocks. And the odd part of that is the fundamentals have held up.
Yeah.
And but we're still watching public equities get destroyed. And so like it raises the question is, as an industry, how do we stay committed to the ROI that we believe is going to exist when public investors are clearly doubting it?
I think you just have to understand where we can go as an organization or as an industry and realize that we have barely scratched the surface.
Yep.
Right? We're trying to figure out how to move from an antiquated, human-centered industry, which we've been for really since inception, to what is possible if we get this technology right? What's the unlock that it will do? How many more families can we help? How many more liabilities can we effectively manage in a better way? What can the data give us on a consistent basis to allow our humans to go execute that? And so I don't know if people are just a little bit short-sighted because we're looking at a challenging housing and affordability market, but you get a little bit of tailwind, and all of a sudden that sentiment changes fast.
Yeah, let's wait for that tailwind. I'm ready for it.
We're all waiting for it.
All right, let's move to talking about like some of that positive impact that like we believe AI can have. So the last conversation that you and Vishal and I had was about cost of production, and there's a lot of critique and belief that different lenders calculate cost of production in different ways. So like from your point of view, from Better Neo point of view, how do you think about cost of production? And let's go into your numbers.
Yeah, the first thing I think as an industry that would be helpful is if we standardize what we mean by cost to produce, right? Because DTC has a cost to produce that's different than retail, that's different than wholesale. You could just look at retail cost to produce, and if you have 100 mortgage professionals that are originating 100 loans, your cost to produce is going to be way higher than if you have one person originating 100 loans, right? So when I think about cost to produce, I just have to think about the manufacturing line, right? And if you put kind of your processors and your loan coordinators, whatever you want to call them, into that sales support role, it's really underwriting, closing funding, post-closing shipping, like that manufacturing process from where it gets into that all the way to close. And I think that number is just skyrocketing down, right? Because our underwriters have gone from underwriting 2 to 3 loans a day to 8 to 10 loans a day. And half of them go by them without them even having to do anything, right? So they just sign off at closing. Our closers and funders are up 90-ish%, which is going to bring your cost to produce down by half. Right, because you can just get more done with the same number of people.
So on that calculation, what's your cost of production today, and do you have a target for where you're going?
It's different, and again, it's different in DTC and retail, because retail we have a broader mix of products, right? So we have non-QM, you have HELOC, you have different purchase products, whereas DTC, the credit box is so small, right? They don't do a lot of FHA, they don't do VA cash out, and so their cost of produce is lower because it's more of the cookie cutter stuff coming through. Ours is going to be a little bit higher. So I'd say it's like maybe $700-800 in their world, and it may be $1,200-1,300 in our world.
And that $1,200 or $1,300 is before you talk about the sales aspect, the commission and cost of lead. Okay. So like, do you compare yourself against other lenders who like include that commission in their cost of production numbers? And
I don't think we can. We haven't set like a bar of comparison in the industry to where everybody can say, okay, if we're talking a cost of produce is from X to Y, then submit those numbers, and then we should all be able to benchmark our performance based upon that. But when the scope is so broad and you don't really know what's included and what's not, it's just all kind of, we put out whatever number sounds the best.
Public company. Either way, it's wildly lower than what we see in the MBA cost of production surveys.
Yeah, I think the main metric is ask an underwriter or a closer or funder or a processor how much more they can do in a day, right? And if they say, in this world I did X, in this world I did X plus 100%, well, you know your cost of produce just went in half, right? Because you're getting a double execution and efficiency from the same employee.
So we haven't, like you talk about going from 2 to 3 loans per underwriter to 8 to 10. We haven't seen origination volume shoot up at that scale. So has there been decisions made on staffing models with underwriters, or is this kind of like where you are and where you're prepped to take volume if you have a boost in originations?
Yeah, I think it's twofold. One is that we've grown a decent amount, right? NEO has grown by about 100% in the last 18 months, just because of new people joining us and then same-store sales increasing. So
that's a metric worth bragging about.
Yeah, but if that's going to happen, we also need more underwriters, right? Because you just need more staff. You need more staff to be able to account for that. So the numbers when we look at in staffing is we try and stay around 75% capacity, which means that we have a 25% runway for some sort of tailwind that hopefully will come at some point. But that's, when we keep growing, those numbers are going to move.
We had a conversation at dinner last night with a few lenders who talked about having fast-tracked underwriting lanes when something is vanilla and all the boxes are checked, but fighting the inertia of underwriters who say, "Oh yeah, it sailed right through, but I'm going to go back and check that." And how have you encountered that at Better, and how have you countered it?
Yeah, so I just actually spent some time with one of our new underwriters. He's been with us for about 90 days, came off of a legacy LOS system, and he just says, "Look, I'm never going back." Right? Like having multiple people in a file at the same time, having everybody get to the finish line at the same time, being able to get through a file in a nanosecond as opposed to waiting for that spinning wheel and all these things. And I said, okay, well, what about, Betsy AI underwrites a good amount of our files that he can just sign off at the end? And he goes, "Oh, I re-underwrite all those." And I was like, okay, can you stop doing that? And he goes, "Well, nobody's told me what happens, like if it's wrong. Like it's my name and my license on the account." And so I was like, well, look, first of all, have you ever had one come back? Have you ever had a major defect, scratch and dent, unsellable loan? He goes, "No." I said, okay, so just know that this is not on you. If it comes back, it's on us. But why would you do that? He goes, "I just want to make sure it's right." And so we're kind of assuming that a human underwriter is right 100% of the time, which we all know they're not, right? And so if the AI underwriting is wrong 2-3% of the time, where does that put us in relation to humans? So we just need the underwriters to feel like what we are doing is their business partner, so they can go from 60 loans to 120 loans, right? And just know that that is their partner in crime as opposed to somebody that's vying for their job.
I'll go back to Joe Whaley's final lesson of it's people will resist, power through the resistance. Have you felt like that has any advice on the culture change necessary to get people to adopt the process you need them to in Tinman and Betsy?
Well, one of it's just necessity, right? And so there's a lot of organizations right now that are kind of rolling out new systems and processes, but it's kind of like, okay, here's your main system, and we're trying this beta, and you're going to get very little adoption because people are going to think that this is, Skynet coming for their job. When in reality, if it's just one system, that's all you have, right? So we have 100% adoption because you can't not use it, right? Now, are they adopting every aspect of it? Are they using all of the intricate natures of it? That's going to be a little bit more of a evolutionary process, but as they see their coworkers doubling their production, earning more income, creating more job safety for them, right? They're going to lean into it a little bit more because their counterparts are doing it.
It's the social proof side of AI.
You just need to know you can trust it.
Okay, so what else is changing in staffing models? Talk about underwriting a little bit. Is the profile of the originator who's successful on your platform changing over time, or are you seeing folks with
the best originators just aren't in it? Similar to what Joe was saying, like you shouldn't necessarily need to be in your CRM. You should get the result of the CRM, right? It's the same concept with Tinman and Betsy, and what we've built is that at best your team is in it, right? But as an originator, as I was running my team, no one even gave me a password to log into the system. You didn't want me in that system, I promise, right? You wanted me out doing Genius Zone activities, business development, client engagement, education. And so it's the same concept, right? We want highly financially literate, incredibly educated mortgage professionals to go do that and then let the system run around you. But what it's done is it's evolved the team structure, right? So we used to have processors. We don't have processors anymore because of what the technology can do, what our team can do ultimately. And so the role of a processor in our organization has shifted more towards a pre-approval specialist and getting them to the front end, right, to help make sure that our pre-approvals are cleaner, faster, using AI to, engage with that process. But the biggest one is like we have what's called a loan specialist, and a loan specialist job is genuinely just to create an amazing consumer experience. Right? Most of the stuff that processors have had to do, they don't have to do anymore. So they get to call on a Monday and say, Clayton, how was your weekend with the kids? What do you got coming up this week? By the way, everything's fine with the loan. Right? Don't worry about it. This is coming next. This is when you're going to hear from us. Like, we get to go be human. Why? Because we don't have so many tasks firing at us, and we're not putting out fires, and we're not behind in our efforts to keep up because everybody's trying to live on the razor's edge of cost. And so it, again, allows us to create a better consumer experience, deepen the relationship, and help people see that we will be there proactively for them for 30 years, not just for the 30 days of that transaction.
So, it sounds like the downstream impacts to the originator and the loan specialist are very positive. There's the threat of when does AI come for the jobs, and I've heard Vishal talk about that, like the jobs that can and will be replaced by AI. How did the positive downstream impacts to originators today look in the future? Does it stay positive, or does like more automation come for the production?
It's the same concept I've used with financial management, right? So I have a wealth manager, and he doesn't actually manage the money. He manages me, right? He manages my emotion of money. It's the same concept for a mortgage professional, but we have to shift the way that we think. If we keep selling loans to people who already want and need them, we should all be replaced, because that will be very much an automated transactional experience. If we start telling people what we really want to do, which is we really want to help them manage the emotion of their current real estate, the real estate they don't have, how they're renting right now, their liability management, their affiliation with debt, right, their cash flow. If we can become that person in the life of the consumer, knowing that the mortgage is really the data that's just going to process behind those decisions, right? Then we can change what it means to be a mortgage advisor, right? A debt advisor, a liability advisor. We can actually fill a space that has never been filled in the history of our industry, right? It's always just been wealth management, but 92% of America doesn't have enough wealth to be managed, but they have a ton of debt. And they want real estate, and they own real estate, and their parents and their children, and we need to help them understand how to create generational wealth with that uncertainty, and that's what technology will allow the future of the mortgage advisor to become.
I'm glad you brought up the consumer. So, like, we are talking about lower costs of production, better advice. When does the benefit flow to the consumer in terms of pricing? Are we there? Is that in the future, or is there so much tech investment necessary that that's going to get absorbed back into the business?
I think there's three winners when you get technology and AI right. The consumer is going to win because you'll be able to be more competitive, because you can strip out cost of fulfillment. So you can pass a portion of that on to the consumer. The other winner is going to be the originator, right? Because now the originator gets both, right? They get a lower cost to the consumer, and when the company is saving and then taking that savings and reinvesting that back into kind of a matured process, right, or an evolved process that supports them so they can become more valuable out in the market, well, then now they actually have a better value proposition, right? And then the organization wins on both sides, right? So lowering cost of fulfillment, creating efficiency has three distinct winners. The consumer gets a better mortgage advisor, right, because they can spend more time with them. The mortgage advisor gets more access to the consumer in an easier process so they can spend more time, and the company is able to then replicate that and grow. So I think it's just kind of a flywheel effect.
All right, let's spin the flywheel. Ryan, thank you.
Yeah, man. Happy to be here.